Hello everyone, and welcome. Today we're going to clarify the guidelines of California's Proposition 19, a significant piece of legislation that has reshaped property tax rules for homeowners across the state. Understanding Prop 19 is crucial for anyone considering a move, planning their estate, or inheriting property in California. This presentation aims to provide you with a comprehensive guide to its property tax portability and inheritance rules, which became effective in 2021. As a quick reminder, don't forget to download a copy of this presentation from my training website so you can study it and take notes. The link to the training website is in the description of this video. And if you enjoyed this training, be sure to subscribe, like, and comment. Your feedback helps us grow and reach more agents like you. Proposition 19 introduced two major shifts in California's property tax landscape. First, it significantly expanded property tax portability. This means certain homeowners can now transfer their existing, often lower, Prop 13 tax base to a replacement primary residence anywhere in the state, not just within the same county or to a property of equal or lesser value. This offers incredible flexibility for those looking to relocate. Second, Prop 19 tightened the rules for inherited properties. While parent-child and grandparent-grandchild exclusions still exist, they now come with strict conditions, primarily requiring the heir to use the inherited property as their primary residence. This change has profound implications for family wealth transfer and estate planning. Property tax portability under Proposition 19 is a valuable benefit, but it's important to know who qualifies. There are three main categories of eligible homeowners. First, individuals who are age 55 or older can transfer their tax base. Second, those who are severely disabled also qualify. Both of these groups are allowed up to 3 lifetime transfers, offering considerable flexibility over the years. The third category includes homeowners whose primary residence was substantially damaged or destroyed by a wildfire or other natural disaster. Generally, these disaster victims are allowed one transfer tied to the specific damaged home. Understanding your eligibility is the first step in leveraging this important provision. Timing is absolutely critical when utilizing Proposition 19's portability benefits. To successfully transfer your property tax base, you must purchase or complete construction of your replacement primary residence within 2 years of selling or losing your original home. This 2-year window is a strict deadline, and missing it can have significant consequences. If you fail to meet this time frame, you will lose the portability benefit entirely, and your replacement home will be reassessed at its full current market value. Careful planning and adherence to this timeline are essential to ensure you secure the intended tax savings. Under Prop 19, when you move and transfer your property tax base, the way your new tax value is figured depends on how the price of your new home compares to your old one. If the new home is the same price or cheaper, your old tax base simply carries over, so your property taxes stay the same. If the new home is more expensive, you still get to keep your old tax base, but the extra difference in value is added on top. This means you continue to benefit from the lower tax base you've built up, while also paying a little more to reflect the higher value of the new property. In short, Prop 19 lets you keep most of your tax savings when you move, but ensures that any big jump in home value is fairly accounted for. To secure your portability benefits, you must meet specific filing requirements and adhere to important deadlines. You'll need to submit documentation proving your eligibility, such as age verification, disability status, or disaster qualification. Additionally, you'll need to provide evidence of the sale and purchase dates of both properties, along with closing statements and title documents. Crucially, you must also file for the homeowner's exemption on your replacement property. It's important to remember the effective dates. The portability rules became effective on April 1, 2021, and the inheritance rules on February 16, 2021. Staying organized and submitting all necessary paperwork promptly is vital for a successful transfer. Proposition 19 significantly altered how inherited properties are taxed in California. Previously, parents could transfer property to their children, preserving the existing low tax base without many restrictions. Now, to maintain the exclusion from reassessment, the heir must use the inherited property as their primary residence, and file for the homeowner's exemption within 1 year of the transfer. The only other exception is if the property qualifies as a family farm and continues in agricultural use. This means that inherited investment properties, vacation homes, and rental units no longer qualify for preferential tax treatment and will be fully reassessed to current market value. This change necessitates a re-evaluation of estate planning strategies for many families. When a property is inherited and qualifies as the heir's primary residence, Proposition 19 sets a limit on how much of the tax break they can apply. The rule is based on a $1 million cap. To figure it out, you look at the difference between the home's current market value at the time of transfer and its old assessed value. If that difference is $1 million or less, nothing changes. The old assessed value carries over, and the heir keeps the full tax benefit. If the difference is more than $1 million, only the extra amount above that cap gets added to the old assessed value to create the new taxable base. For example, if the gap is $1,200,000, then the $200,000 is added to the old assessed value. This way, heirs still get a large tax break, but very high value increases are partially taxed. The $1 million cap is also adjusted each year for inflation, so the limit can grow over time. Under Proposition 19, several types of inherited properties no longer qualify for the parent-child or grandparent-grandchild exclusion, leading to full reassessment. This includes rental properties and other investment properties. If you inherit such a property, it will be reassessed to its current market value, potentially leading to significantly higher property taxes that could impact your net rental income. Vacation homes and second homes also fall into this category. They will be reassessed unless the heir converts the property into their primary residence and files for the homeowner's exemption. Even an inherited property that could serve as a primary residence will lose its exclusion if the heir fails to occupy it and claim the homeowner's exemption within the required time frame. Proposition 19 offers significant opportunities for homeowners, especially those moving in retirement. It allows you to maximize your mobility without the shock of a massive property tax increase. You can now shop statewide for your ideal retirement location, whether it's closer to family, in a different climate, or a more affordable area, and still potentially retain your favorable tax base. This flexibility was not available before. Strategic coordination of your selling and purchasing timelines is key to leveraging this benefit. It's also wise to consider current market conditions and familiarize yourself with the specific assessor forms and procedures in your target county. The changes brought by Proposition 19 have profound estate planning implications for families. It's now more critical than ever to review and potentially revise your estate plan, especially concerning real estate. For primary residences, families need to strategize whether an heir will genuinely occupy the home to maintain the tax exclusion. For rental portfolios and other non-primary residence properties, families must anticipate full reassessment upon inheritance. This could significantly impact the financial viability of holding onto these assets. Open discussions within the family about future intentions for properties and potential tax burdens are essential to avoid unintended consequences and ensure your legacy aligns with your wishes. When considering property improvements, especially accessory dwelling units, it's important to understand their impact on your property taxes and future portability. Adding an ADU typically triggers a partial reassessment, but only on the new construction itself. The original Prop 13 tax base of your existing home and land remains unchanged. The assessor simply adds the value of the new improvement to your existing assessed value. When it comes to portability, if you move to a home that includes an ADU, the ADU's value is factored into the replacement property's overall market value when calculating whether it's of equal or greater value than your original home. ADUs can be valuable for income or family housing, but understanding these tax implications is key. Navigating Proposition 19 can be complex, and there are several common pitfalls to avoid. First, missing the 2-year window for portability is a frequent issue. Always track your sale and purchase closing dates meticulously. Second, for inherited homes, insufficient residency documentation can lead to reassessment. Gather comprehensive proof of primary residence use. Third, in California's dynamic real estate markets, underestimating market values can cause you to exceed the $1 million exclusion cap for inherited properties, leading to unexpected tax increases. Finally, be aware of county procedure variations. Each county assessor's office may have slightly different forms, filing procedures, and documentation requirements, so always check with your specific county. Let's quickly summarize the key actions for different scenarios. If you're age 55 or older or severely disabled and planning to move, your goal is to preserve your low property tax base. Ensure you sell your original home and purchase your replacement within 2 years, file all necessary portability applications, and maintain thorough documentation. If you're inheriting a primary residence, your goal is to maintain the parent-child exclusion. You must move into the property, claim the homeowner's exemption promptly, and verify the market value against the $1 million cap. If you're inheriting rental or vacation properties, expect a full reassessment. Update your financial projections, evaluate ownership options, and consider refinancing or even selling if the new tax burden makes it unfeasible. To recap, Proposition 19 offers expanded portability for eligible homeowners, allowing them to transfer their tax base statewide. However, it has significantly tightened inheritance rules, requiring heirs to use inherited properties as their primary residence to avoid reassessment. Throughout this process, meticulous documentation is paramount. Most importantly, early and strategic planning is essential, whether you're considering a move or planning your estate. We strongly recommend consulting with qualified professionals, such as real estate attorneys, financial advisors, and tax specialists, to understand how these rules specifically apply to your unique situation. Additionally, always reach out to your county assessor's office for the most current forms and filing procedures. As a quick reminder, don't forget to download a copy of this presentation from my training website so you can study it and take notes. The link to the training website is in the description of this video.